Navigating through the homebuyers maze, educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Navigating through the homebuyers maze, educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. Josh breaks it down, the numbers make sense. Jeb shows a vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Happy Wednesday. Welcome to the Educated Homebuyer Live. It's our Wednesday edition. I got Josh here. He's in Washington State, coming to you. We're teleporting him in this evening. So welcome to the show,
Yes.
Josh.
It is hotter than Hades here in Washington right now. It was 95 degrees today.
Nice. Well, good to have you in. Thanks for showing
For teleporting in.
Showing the support here from even while on vacation. So you guys get to hear Josh tonight, but we're going to go over charts. We're going to talk about what's happening in the housing market. 78 housing markets at the moment are back to pre-pandemic levels when it comes to inventory. We're going to look at what those, which areas those are in. We're going to talk about what that actually means for the housing market while we're looking at charts, answering your questions live. But I always like to start by asking where you guys are watching from. Let us know in the chat. Start putting your questions in there as well. So as we come out of the graph picture fun part of the show that you guys all love, we can start answering some questions.
Looks like I'm not the only one in the Pacific Northwest right now, Jeb. So maybe if you guys are also watching from Portland, Olympia, Seattle, Bellevue, the inland Northwest, like Spokane, tell us all about it.
There you go. Actually, go meet Josh.
We'll have
a meetup. I like it.
Beers and educated home buying.
I like where your head's at, Josh. So let's do as we always do and take a look at some charts. So this week, Josh, we actually saw something we haven't seen in quite some time. We actually saw inventory go down. So we dropped from 853,000 homes last week to 846,000 homes. Last year, we were sitting at 652. Still have 30% more inventory right now than we did last year. I don't think this is the peak in inventory quite yet. I think there's some seasonal things in there, probably some plays from the holiday kind of rolling over into this whole thing. And the reason I think that is because we're taking a look at some other charts here, which is up to date. So that information you just looked at there is about a week old. It's last week's data. We just got it this week. Whereas this information here is accurate. It's this is local, but it's up to date. And Orange County sitting at 5,033 listings, which is up 3% week over week. And Huntington Beach sitting at 303. We actually saw a 7.2% increase week over week. So we thought we were headed lower past that holiday season, July 4th, that sort of thing. We're kind of in that summer lull in the market, but inventory is continuing to increase, which is why I think you'll probably see that reflected in the national numbers as we head into next week. We talked earlier about markets that are back to pre-pandemic levels. So at the moment, there are 78 of them. This is broken into two lists because 78 wouldn't fit on the screen where you could actually read it. So as you go through here, you're going to see, kind of it's a little bit of everywhere, but the concentration again is big time Southwest part of the United States. But you have a lot of different states in here that are back there, but they're even counting as we move into the second one, Josh. If you're at 0%, you're back. So even if you're not increased, you're still back. But a good percentage of these are still in the single digits. But you still have 50, 60 or so that are more than 10% above pre-pandemic levels, which is good. It's good if out there if you're a buyer. A little bit more leverage, a little bit more negotiation. I'm seeing it on my side, on both the listing and the buyer side, which we can talk about as we start answering some questions.
Absolutely. We had a listener. I just got a contract right before we came on here, and they were able to cut the price, get some concessions, all of the above.
Yeah, no, it's definitely more of that. So as we look at new listings on the market, we have the idea is that we've already peaked in new listings for the year, that we're not going to see new listings move much higher than we've already seen. But, we did see a significant dip last week, but the expectation is a rebound as we move into next week, just because of, again, some of that holiday stuff plays into the numbers. But for context, years of the housing bubble crash, we were seeing 250,000 to 400,000 per week. And that was not just a month, that was over the course of years. This past week, we saw 60,000 compared to last year, sitting at 56,000. So it's down, still above last year, but at the end of the day, it's positive, which is a positive thing for the housing market. When it comes to weekly pending sales, last week's data showed year-over-year growth, but this week-to-week, the week-to-week data, like other weekly data lines, took the traditional July 4th holiday dive. We should get back to a more normal trend next week. We were sitting at 61,000 versus 58,000 last year. And then on the total pending sales, we actually saw that increase as well, sitting at 387 versus 381,000 last year. And this is, at a time with elevated rates and, just still seeing some growth out there year over year, which is positive in the housing market. But we are seeing price reductions still continue to happen, an increase sitting at 40.7%. So if you're looking at this chart, the peak typically happens over the next 2 months, but it depends on where rates are, and what happens with rates will kind of drive where we see those price reductions. Now, Josh saw this chart last week. It was unfinished at the time, just because of missing Case-Shiller for May, but this came out of calculated risk. Again, it just shows where each of these have year-over-year price growth. And as you can see, we're starting to trend down, right? We started the year 3.9% with NAR, Case-Shiller 4.1%, Freddie Mac 4.1%. And then we're trending down. As of May, NAR is at 1.3, Freddie Mac's at 2.2. I don't remember where Case-Shiller is, 1.9 or somewhere in that ballpark. But we're seeing that year-over-year home price growth continue to decline. There's an expectation out there that it could be flat by the end of the year. So we'll continue to watch it and update you. We have had news since last week, Josh. We had inflation come out. Which was Tuesday, we had PPI as well. So there's some things out there.
Yeah, PPI today. The big one yesterday was CPI, because the expectation is, hey, there's a lag between tariffs and actually showing up in the data. And this was kind of the feeling that this was going to be our first month where it showed up in the data. And it didn't really. We're a little bit up month over month, down up 0.1 the prior month, up to 0.3. If we average out the last 3 months, it's 0.2 month over month. The issue with why we saw the headline, and if you looked at the Wall Street Journal, you look at your local newspaper saying, oh, inflation ticks up. It didn't really tick up. We're right in line with where we've been over the last 6 month average. But this time last year, we had 2 or 3 really low months. So you can see June of last year fell off. It had a 0. July is going to be a 0.1. So if you get another 0.3 or even a 0.2, next month, headline inflation is going to increase again. The Fed prefers the core. They actually prefer core PCE. But at the core, pretty benign. We had really low in March and May, 0.2 in April, 0.2 in April and June. March and May were the low months. So we're not seeing a big pickup. We're just not seeing the moderation. We still have not got back to the level that the Fed is looking for. They're not seeing weakness in jobs. They're not seeing inflation moderate at the rate that they would like to, down to the 2%. So looking at a couple of other things, this is the Cleveland Fed's nowcast on inflation. They're expecting next month to look a lot like this. If you look at these numbers, it's not making progress down towards 2%, but not really worsening. We're going to see, because now the belief is the next 1 to 2 months should have a better capture of the impact of tariffs. Now, the reality is it's kind of a moving target, continues moving, pushing things further off into the future. So I don't know when we're going to actually see the impact of tariffs. It hasn't been there so far. An alternative look here is Trueflation. Trueflation's at 1.82. A week ago, it was 1.66. Yesterday, 1.82. So no change day over day, but up a little week over week, but down over the last year. And that is truly a nowcast of what they're seeing. And this over time, over the long haul, has a 99.4% correlation to CPI. So from that perspective, not really seeing inflation pick up. According to the measure, depending on the measure you look at, we could actually be where we need to be. So, Jeb, I didn't pull the charts in for PPI, but PPI was very moderate today.
Yep.
Did not pick up any tariff impact. Some of why the market reacted to CPI yesterday, when it was actually a little bit better than market expectations, was the simple fact that the pieces inside of that data, furniture, toys, a few other things, were picking up and showing some of the preliminary impacts of tariffs that could be worse in the future. After that data yesterday and then today, we're at a 97% chance that the Fed does absolutely nothing in July. So I think everyone agrees at this point, we're not going to see anything in July. Hasn't really changed the outlook for the rest of the year. Still an 84% chance in the Fed funds futures market that we're 50 basis points lower by the end of the year. There wasn't really a chart for this, Jeb, but the highlight or low light of today, depending on how you look at it.
Good old buddy Trump.
Trump thought he had found a loophole to finally rid himself of his nemesis, Fed Chair Powell. And depending on what your thoughts are, you may think this is great. You may think this is awful. The reality is, if you think Powell was the one in charge of cost overruns for redesigning the offices of the Federal Reserve in Washington, D.C., you're a little bit insane. So if that's the loophole that you want to fire him for because he's not properly managing the Fed, you can go ahead and do that. But the futures markets spoke very loudly during the day. The volume spiked and spiked in a negative way, and the yield curve steepened. So what does that mean? It means short-term treasuries improved a little bit, because if we get a more dovish Fed chair in there and they do what Trump wants, whether it's 100 basis points, 200 basis points, 250 basis points over a fairly short time frame, that impacts the short end of the curve. At the long end of the curve, 10-year, 7-year, 30-year, where we see greater impact on mortgages, it's negative. It's inflationary, because
he was just kidding.
There. I'm just kidding.
He's just kidding.
Yeah, there are people who say they saw the letter drafted that he was going to do it. So who knows? Both may be true. He maybe was going to do it, and then he just changed his mind. We don't know.
Kidding. Yeah,
we don't know.
No, in all reality, for those of you who don't know, he did come out and say that he was kidding. Bond market kind of took it in stride. Is that a tequila high noon?
Yes,
what are
I'm
we
on
doing
vacation.
Here?
I'm vacationing.
Bro, you didn't even send me
I'm checking in from my vacation. You're not on vacation.
I mean, I leave tomorrow for vacation.
Okay, tomorrow.
I mean, so technically I'm on vacation right now.
Okay.
You should have had one delivered for me on my desk. I didn't know we were going that direction. Anyhow, for those of you who didn't know, he did say he was just kidding. Bond market kind of took it in stride. Didn't see a big reaction either way at that point. But I think at this point, they've determined that the man's crazy and he doesn't know what he's going to do with Fed Chair Powell. And at the end of the day, the market doesn't like the volatility. We've talked about it so many times. They want stable markets. And yeah, that sort of thing's not good. It's really that
the shortest path to lower rates is clarity on tariffs and limiting them to the countries that we have trade issues with, valid and real trade issues with. So it's not that it's a made up issue. It is a real issue, and they have every right and reason to be pursuing better trade deals with many countries around the world, but with every country in the world. We talked about it last week. I don't think we need to be renegotiating our trade deals with Serbia. I don't think it's going to help us, United States citizens.
There you go. So what are we looking at here, Josh?
Oh, there's you see the two little green bars. We were in a nice down channel till about 8 days ago, and clearly broke out of that to the upside. We have an uptrend going here. If we were to zoom out further, it's really sort of a sideways market. This isn't such a big move. The bottom there, we're about 420. Here at the top, we're under 450. So that's about a 0.25% range in interest rates. That's a pretty narrow range and kind of a sideways range. We would expect 451 to hold at the high end. If it doesn't, you could run as high as 460, which is kind of what the high of what you've seen here. So long story short, more of the same of what we've seen. We're not getting a sustained continued improvement. When they worsen, they kind of hit a ceiling and bop back down. So what does that mean in terms of interest rates? 30-year fixed about 6.875. Government loans, FHA and VA still under 6.5. You're going to do better than that if you have really good credit, well qualified. What does that tell us? Day over day, pretty much flat. Week over week, a little bit worse, and month over month, a tiny bit better. So really, really sideways in that regard.
And when you said that we could go as high as 4.6 on the 10-year, how does that translate into mortgage rates? So if we have the spread, which we looked at last week, sitting somewhere around 2.4 something, if you have a 10-year at 4.6, you're looking at 7% mortgage rates, right? Somewhere in that ballpark.
That close to 7%.
Yeah. So really, really close. So we will see. But with that said, if you're somebody waiting on the sidelines, waiting to see where rates go because you're trying to refinance, you can get on our rate watch list at jebsmith.net/rate watch. We will reach out as rates improve and help you take advantage of that. And we'll give you a link here in just a moment, Josh, where they can scroll and contact Josh if they need a pre-approval or want to discuss real estate or anything about the home buying process. That link at the bottom will get you in touch with our team, jebsmith.net/start. All right, Mr. Lewis. So what are we looking at here with regards to questions? Do we have any questions? We got a lot of people letting us know where they're from. What do we got? Do we got any new ones?
How many do we have in Washington? We got Miss Taylor is in Washington. There's at least another one, Spiral Gazelle, in Washington State as well. We're limited on our Pacific Northwest participation, but we got Louisiana, we got Wisconsin, we got Florida, we got Boston, basically covering like all four corners of the U.S. there. And then Heather, as always, representing Inglewood for us.
There you go. Dedicated to the show. We appreciate that. Let's see. We always have questions. We got Cleburne and Little Rock. We always have questions about where interest rates are going. But is there anything else in there that we can touch on before we dive into that, Josh?
Willing has an interesting question, and I think it's would be of interest to everyone. How do you accurately account for property taxes for loan applications? For those of you who don't know, Willing is in the mortgage business. There's so many factors that influence what that specific borrower will actually have. So I'm in California, Jeb's in California. In California, we start with a baseline expectation that it's going to be 1.25% of the sale price. Most states around the U.S., we're going to look at the current taxes, and that is what's going to be used for qualification because they don't have Prop 13 like we have here in California that makes the current owner's property taxes artificially low. So from that perspective, we always have to look out. There can be property tax exemptions, veterans exemptions, widows exemptions, senior citizens exemptions that can artificially suppress what the property tax rates show up on the tax rolls. But for the most part, unless the seller has some sort of unknown exemption, in most states outside of California, we're going to use the property taxes as they show up on title now.
All right, good stuff on that one. We also had a question. Would you live in the Pacific Northwest, Josh? Would you live up there?
I could do the inland Northwest, North Idaho, Spokane, much more to my liking. It's a little colder in the winter over there, but on this side of the Cascades, it is very gray and very rainy, and Josh does not deal with it. I will deal with cold before I will deal with day after day after day of cold, rain, drizzle, gray.
Got it. Feels like you're in Huntington Beach. Not right now. It's finally sunny, but it was
Buddy,
gray
you
for
don't
6 months.
know. You don't know. Our gray in Huntington Beach is a bright, sunshiny day for most of the year in Seattle.
No thanks. All right, we got what I can't even read that thing from here.
Multi-rage 1, 2, 3, 4.
There you go. Do you think by the beginning of 2026 should be the best time to buy before the summer hits? It depends. I mean, again, what are your goals, right? We often talk about here about not trying to time the market. What typically happens at the beginning of the year? The beginning of the year is when people start thinking about the home buying process, right? So it's kind of the beginning of when inventory starts to come back after a seasonal decline, which is generally what happens in the fall winter market. So you got more inventory coming to the market, and then you typically start to have more buyer demand as you get into mid-February and move through that spring housing market. So yes, you get more inventory, you get more demand, which we've showed charts before. Well, that's also where the majority of appreciation happens at that same time, right? So you get the majority of appreciation happening in that spring market of the year, and then things start to settle down. Now, it's hard to say what 2026 is going to look like at this point, just because we don't know where rates are going to be, right? Rates are going to drive the housing market going forward for the next couple of years. I mean, it's going to be very rate dependent. And I think because the Fed's already telegraphed, hey, we're cutting 2 times or the Fed hasn't telegraphed. They've said that, they're likely to cut rates a couple times this year. And then the futures market is showing 2 times this year. That's already built into the market. So interest rates aren't likely going to decline based off the Fed doing something at this point. You need a break in unemployment. You need inflation to start to moderate consistently over months so that we get closer to that 2% target. And I think that's where you start to see rates improve on a more consistent basis and stay at these levels versus seeing the volatility that we have. So if that happens sooner, it could be a better time sooner. If it happens later, it could be a better time later. So I would say don't put a date on it. Get pre-approved sooner than later. Know where you stand. When the right house, the right opportunity presents itself, it's in your price range, you feel comfortable about it, that's when you pull the trigger.
For me, Jeb, the way I always like to look at this, I think deals will be better in that fall winter buying season as you have less competition.
Sure.
But you also have less to choose from. So if you're you're looking for a very specific home, specific neighborhood, you may not be able to find as much. Sellers are generally more motivated in that time frame, and these are broad strokes because what I would always say is a really nice home is always going to sell no matter what time of year they bring it on the market. But in general, when you're looking, that's the advice that I give people: be above and beyond, buy when the time is right for you. If you want more variety, spring, summer is great. If you want better deals, then the fall, winter is a little bit better.
All right, Jay Money's got a question that we haven't really heard a lot, and that's what are the benefits, if any, to filing your home to a homestead exemption on your taxes, Mr. Lewis?
So in general, what they do, it vary from state to state. Some of them are as little as $10,000. Some of them are as high as $50,000.
I think it's $7,000 in California or something, isn't it?
It's something a tiny little amount. So if we say 1.25% tax rate in general in California, when you reduce your tax base by $7,000, we're talking $85. It's not a big deal on your tax bill, but you would always do it, right? If someone offered to give you $85 a year every year and you just had to fill out a piece of paper, you'd say, okay, cool, I will do that. So some states have better homestead exemptions, and basically all it is that if it's your primary residence, they'll give you a homestead exemption where you can reduce the assessed value of your home by that exemption and reduce your tax bill a little bit, your property tax bill a little bit.
There you go. Stephanie asks, how do interest rates influence investment decisions, Josh?
Real estate investments, other
just
investments?
Investment. I mean, you can go both ways. Let's talk real estate first.
Yeah, well, we saw what happened when interest rates go really, really low. Then the affordability increases, and you have more demand for homes, more demand for investment properties in general. As they go higher, the numbers don't pencil out. So if you're looking at buying an investment property at 7% versus 3%, the same property with the same rents is going to look very, very different to you on paper. So we have a ton of rentals out there that were either purchased with really low interest rates or refinanced to very low interest rates, that those owners are sitting pretty because their monthly payment is very, very low relative to what the current rents are. Now, if they were wanting to sell, selling is a little bit of a different issue because current buyers of investment properties are in a different spot. The cash flow is really difficult. So a lot of what we're seeing primarily right now in terms of investment properties is people doing 1031 exchanges, where they exchange from one property to a better property. I have a buyer right now. They built up a bunch of equity in a single family residence. They're selling that and they're moving into 4 units that just has better cash flow. But if we're talking just investments in general, different investments do better in low versus high interest rate environments. Rates are generally high when the economy is hot, things are going gangbusters. There's a certain type of investment that's going to work well in that structure. And then there's others when rates are really low. Financials like banks are going to do better in that type of environment because they have more lending activity going on.
Good stuff. Chris is asking a question that's going to lead us to a podcast episode. So Chris says, buy down rate or 1-2 buy down. So here's the thing. Josh and I recorded an in-depth episode on walking you through buy downs, permanent buy downs versus temporary buy downs, pros, cons, all of that good stuff. It's actually going to drop on Monday on the Educated Homebuyer podcast on Spotify and YouTube, as well as on Spotify and Apple. And then it's also going to drop here on YouTube as well. But overall, Josh, what's the short answer here without going too deep?
So a permanent buy down, you're able to use to qualify. So we lower that payment, you'll qualify for a little bit more. You're going to get less benefit, but it's permanent forever. However long you have that home and that loan, 3 years, 5 years, 30 years, you're going to have that benefit. A temporary buy down is kind of smoke and mirrors. We're taking money, setting it aside to subsidize the payment for 1 to 2 to 3 years. So from that perspective, you have to look and say, what am I really trying to accomplish here? Am I incredibly confident that interest rates are going to be better in the next 1 to 2 years? If so, the 2-1 temporary buy down could be good. If you're in a situation where, hey, we are maxed on our qualifications, maybe we have some paper income that we can't document, can't show, so we still need to max what we're looking at doing in terms of buying, then the permanent buy down can be better.
All right, good stuff. But if you are interested in more information on that, it'll drop next Monday on all the channels. We'll talk about it here on Wednesday just to remind you of that. But it's kind of going back to the core of the Educated Homebuyer, where we started the podcast and we were really teaching different things about the mortgage and real estate process, kind of walking you through it. So it's a deep dive. I think you'll find a lot of value in it. So make sure you check it out. So
if you're watching here on Jeb Smith's channel, make sure you go to the Educated Homebuyer, like and subscribe, and then you will get notifications weekly when those new episodes go up.
There you go. Got to hit the bell notification though. I never tell people to do that.
Hit the bell. Hit the bell.
I don't hit the bell. I don't hit the bell. It just pops in my feed, whatever I've watched.
I don't hit the bell either. The algorithm's gotten much better about cramming what you like in your face.
Yeah, exactly. Shanae has a good question. If you're eyeing a particular neighborhood, don't know when things will go on sale, do you still suggest having a pre-approval on hand? What are the best steps? I say yes, absolutely. If you think you're going to be buying something, if it pops up in that neighborhood, assuming it meets the criteria, why wouldn't you be ready? Versus having to deal with it after the fact, right? It's one of those things that, sellers call me and they say, hey, Jeb, I just found the best property. I want to buy it. And I'm like, okay, but you own a house. Do we need to sell it? And they're like, yes. And I'm like, okay, why didn't we have this conversation before you did that? Same thing with buying a house. If you are buying a house that you believe you're going to fall in love with something in that neighborhood, get the pre-approval now. That way, you know what you're working with, right? Idea of payment. You have an idea of your price point. Everything that you need to know in order to make logical decisions, not emotional ones. So the sooner you can do that, the better. In fact, that link scrolling the bottom of the screen there, jebsmith.net/start, will get you in touch with Josh and the team. Can walk you through the pre-approval process, guide you. We're helping people here weekly. We've helped, I don't know how many people this year, Josh. I mean, a ton. But over the course of 3 to 4 years, hundreds at this point. So just, we'd love to help.
Yeah, but I've got an interesting one here. I have someone swimming against the stream, going from Texas, moving back to Huntington Beach, California. Their kids are in California. They're like, we're coming back. And they knew their situation. They make good money. They have perfect credit. And they're like, we're good. We'll get pre-approved as soon as we find the right property. We don't want to go through all those steps until we find the right property. And we're clear to close within 13 days. So it wasn't hard, but like the first few days, They have a complicated situation. And in their mind, hey, we've bought houses before, we're very well qualified. And they are. But it still doesn't mean you don't have a complicated situation where there's some back and forth for several days. And when you're under the gun of, they literally had written an offer and had the property under contract before we even got them pre-approved, which is a little bit backwards, but it worked out.
Hold on. So they got an offer accepted without a pre-approval? Fantastic. That agent's really doing their due diligence.
Really doing their due diligence. They promised them. They said, we're very well qualified. Trust us.
Hey, we're good. We're good. Just accept our offer. We'll get it. We'll make it happen. In better news, Josh, I have, for the better part of a couple of weeks, had a lot of issues with a lot of transactions. Two of them
are they all solved? Are they all resolved?
Let's not get ahead of ourselves. Two are supposed to close on Friday. One of our longtime listeners who you helped with the mortgage at one point. Now I'm helping her sell. She's moving up to
she's
Oregon,
here in Washington. We've got her
Yes.
pre-approved, and she's looking at homes here in Washington.
So hers is going to close on Friday. Huntington Beach is going to close on Friday. The one with the assumable loan just got an offer accepted today. 10-day close, 1031 tax exchange. Solid offer.
So they're not assuming the loan with the 10-day
Not
close.
assuming the loan. We had an offer for assuming the loan, which we were getting close to accepting, and then this offer just came in all of a sudden, and that was the better deal. It was cash. It was ready to go. So we took that one. Our property here in Huntington is back in escrow, and got a couple more coming to the market. So things are trending upwards, Josh. Just keep your fingers crossed.
You need a vacation more often. You need a vacation more often because everything falls in place for you when I leave.
Yeah, well, I mean, let's not get ahead of ourselves. Where are we on our office lease, Josh? Should we bring that up?
No, we don't want to talk about it. I don't want to talk about it. We're not going to deal with it.
Just we're not going to discuss it. It'll figure itself out.
It'll solve itself.
All right. Isaac said just locked in 4.75 on a new build, Northern California. Hopefully it was a good decision. So the reason I clicked on this is, again, with new builds out there, there's a lot of incentives still. We've talked about it before. Builders aren't in the business of holding on to property. It's like investors who flip property, right? They're not in the business of holding on to these things. They want to sell. They want to go under contract. In the case of new construction, there's typically a bit of a margin there that they can use to help buy down rates. So if you're considering new construction, make sure you're negotiating, especially in this market when there's a lot of inventory out there. You've got options.
Jeb, I do not remember who it was, but did you happen to see, like 10 days ago, it was, I want to say it's KB, one of the big national builders does not do the buy downs. They will cut prices. And they came out and said, they came out and basically said, hey, all of these companies are setting these people up to fail by holding prices artificially high and buying rates down low. So it can be a double-edged sword, but in terms of what we always talk about, to a buyer, the most important thing is the monthly payment. The monthly payment's much better at 4.75 versus 6.75. So even at a higher price, even taking longer to build up equity, the most important part is that monthly payment, and that's what we're seeing the builders do. It's the game they're playing.
Good. Yeah, I think it was a Resi Club article. I read it as well. I don't remember 100%. This is a good question. Taryn asked, have you ever had two different clients bidding on the same property? How did you or would you handle that situation representing both clients? I have had multiple times in my career. And I'll be honest, I've never, in those situations, none of my clients have ever actually gotten the property. So it's never been like a weird thing for me. But what I will tell you how I handled it, I had it happen a lot during the pandemic and the COVID era. What we try to do as agents is get as much information from the seller, the selling agent, as possible so that we can provide that to our clients. Along with that, we provide comparables on, hey, is the house worth this, or this is where I think the house, the price should be. Never do I tell a client, hey, this is what you need to offer on a property. Right? This is the number. Because at the end of the day, it's not my decision. I give them a range of what I think it's worth or where it could be worth based on comparables, and that kind of let things go from there. And that's what I do in those situations. I tell them, hey, these are the things that we can do to strengthen the offer. If I was the one making the offer, this is what I would do in order to put myself in the best position possible. And you have to do what's right for you, but this is what I would suggest. And some people take it and say, hey, this is what I'm willing to offer. Some people say, no, that's too aggressive. I want to do this. So, rarely are you going to find two people doing the exact same thing without telling them exactly what they need to do. So it's, as an agent, you guide people, you don't tell them, and you just give them as much information to make logical, rational decisions. And in that case, there's no gray area. It's just, hey, you got it because you made the better offer. And that's where it's at. So,
And from a lender's perspective, we cover a pretty broad geographic area, so it doesn't happen that often. And more importantly, when it does, it's super simple for us. I have had a couple of buyers say, hey, we need pre-approval. We're going to write an offer on this. Cool, what's the property address? And another one calls 2 days later. Hey, we're writing an offer on this. Cool, what's the address? Oh, crap, they're both offering on the same property. From our end, all we're doing is reaching out to the listing agent saying both of these people are incredibly well qualified. You will have an awesome time working with either one of them. And then it's really up to the seller and the listing agent to make up that decision. The fun one, Jeb, is what I had a lot during COVID is buyers saying, I'm just going straight to the listing agent. You're like, well, the listing agent has 30 offers and they had 6 other people come to them. So when you guys as an agent have a super desirable listing and everyone thinks, I'm going to cut to the top of the line by doing that, you're like, it doesn't really work that way.
No, exactly. Money bags. Do you anticipate the housing market growing moderately in SoCal or declining? I think prices continue to stabilize. I think you can see, again, Josh and I disagree on this. I think you can see homes in neighborhoods sell for less than the house down the street sold for in some situations. Now, again, location, like all that thing, like the parameters of the house are obviously important. And it's not really happening at the moment. But what I am seeing is people wanting to make a decision for one reason or another. Maybe they're looking out of state. I mean, I had a client in South Huntington. Our first offer was at $1,390,000, which was, we listed at $1,400,000. We lowered the price. We're down at $1,325,000. They ended up taking, a bigger haircut on that price. And then the actual house that sold down the street, similar property, our location is better. Our lot size is better. They sold for a little bit less. Why? Just time. Like, they are ready to be out of California. They're ready to buy their house in Arizona. They've had enough equity in it. They're doing what they want to do to make that decision. So I think there's other factors that play in there. Are you going to see big price declines? No, but you can see a little bit of weakening in markets where inventory's up and things are just slowing in general.
Well, go back and listen to this week's episode of the podcast, Money Bags, because we covered it in more depth there. But I think it's largely dependent on interest rates. If we get that dip in interest rates, and I mean a significant dip, not to 6.5, if you get to 6, under 6, you're going to see home price appreciation. That being said, if we're stuck in this range of 6.875, like we talked about at the top of the show, that's stagnation in most of the country, and many markets will see corrections. The most frothy, the most overpriced, the ones that had the most second homes, the most net migration during COVID, they'll have some pressure and correction. And bigger picture, the most important thing that you'll see is negative real price growth. So once you factor in inflation, home prices won't go up as much as inflation. And we show the numbers occasionally here on the show. Wage growth right now is about 4.3% annually, and you're, that sucks, doesn't sound like very much. Well, if you have 4.3% wage growth and you have negative real home prices over the next 4 or 5 years, you have people making 20-25% more than they're making now. And if you then get a lower interest rate, that's above and beyond all of the reasons why we're not likely to see a major correction nationwide from the standpoint of people with really low rates sitting on a ton of equity. There's a lot of reasons economically why you're unlikely broad market to see a big correction. But interest rates will say, do we stagnate? Do we stay here flat overall? Or do we get some appreciation, which is going to require rates to move lower? Right now, we're kind of at an impasse. People don't want to sell. There's not a lot of demand for people to buy. And something's got to give to change that.
Good stuff. Miscellaneous of the whatever says Taylor Morrison is offering 3.75% 7-year ARMs, and ask what was the common ARM during the great financial crisis that got people into trouble. So there's a couple. Primarily what was the issue during the GFC time was 2- and 3-year ARMs that were adjustable based on LIBOR. They were interest only in many cases. Some of them were negatively amortized, which means they weren't even paying the full interest on the loan, and that additional interest that wasn't being paid was adding to the balance of the loan. So the balance was going up, and prices were essentially stabilizing and starting to decline at that time. So that's what created that. 7-year ARMs in this market, I feel like, are safe, assuming you know what you're getting into, right? I mean, I think 7 years is plenty of time for something to happen with rates to be able to come down and take advantage of a lower rate. But at the same time, you got to be comfortable if it doesn't, and you're in that rate for 7 years, and you got to make a decision at that point. Anything there, Josh? Anything to add?
Really, the loan programs now today are so different. Not just the 2 and 3 year arms, so 228 to 327. 90% of those at that time were interest only. The interest only period was only 2 or 3 years for most of those. So they would go up 2%. Like they had caps. So at the end of 2 or 3 years, they're going to go up 2%. Many of them would become fully amortized, so the payments shot through the roof. You had to be able to refinance to not have a monster payment shock. Those programs no longer exist. Option arms were the other one, where you could go to 110% of your original loan balance, and it didn't take all that long to get there when you're making a 1% payment and you're at a 6.5–7% interest rate. So those are all gone. Hybrid arms, 5/1, 7/1, 5/6, 7/6. The second number just tells you, does it adjust once a year? Does it adjust every 6 months? They have caps. They have limits. So that 3.75, it's either going to be a 5 or a 6% life cap. With a 5% life cap, the worst it could go to is 8.75. So is that going to kill you? No, that's 2% above where the market is now. But we're talking 7 years down the line. And for it to cap out like that, let's say it's a 7/6, where it adjusts every 6 months. It would probably have a 1% cap every 6 months. So to get to the life cap, 5 or 6% above, would be at least 3 years. So you're talking 10 years down the line. And go back, use the same logic that we just talked about. If you get 4% annual wage growth for the next 10 years, you're making 50% more money than you make now.
There you go. Good stuff. We've got Chanel in Washington as well. Josh, a lot of Washington, like maybe they're feeding the channel to Washington viewers tonight because you're up there. Maybe
they
it's
must
Geo.
know. Chanel is actually says she's in Olympia. I am in Olympia right now on the shores of Black Lake here.
You guys should meet up and have a beer. You and Chanel.
Dang, if she brings the beers, if they bring the beers, I don't know. Chanel, I don't know. If they bring the beers, I'm in.
Why'd you go they, bro? Well,
Chanel, I don't know. Chanel, I don't.
We're going she.
Assuming. I'm not assuming.
We're going she.
Okay.
All right.
Chanel, correct us. Correct us if we're dumb.
All right. Let's see.
Let's go back to this one. Barry is a client, long-time listener, at least 2+ years, probably more like 3. His sister is buying a condo. There's a condo for $540,000 purchase, 20% down, 6.875% rate. Good. Okay. Trick question, because we don't know enough. You gave us another piece of it. You said $130,000 cash to close. So $540,000, 20% is $108,000. If we have $130,000 cash to close, that is $22,000 cash to close. So we're not getting 0.6.875. We're paying for that 6.875.
Sure.
So from that perspective, most people don't realize another key thing here is condos, conventional loans, condos less than 25% down have an additional 3/4 point hit. So looks like she's probably paying that out of pocket. So just more details there. And Barry, I know you reached out. I'll call you when we get off the show here and we can try and connect with your sister. It may be an okay deal. It's probably not the way that I would structure the deal.
All right, there you go. Can you get a better deal? Barry, there's one way to find out, my man. Yeah, you hit that link at the bottom of the video or in the description. Wesley, when you refi an ARM, are the closing costs the same or similar on when buying the house, Josh? So when you refi, just in general, whether it's an ARM or a fixed rate or whatever, are the costs similar as to when you're buying?
The type of loan that you have has no impact on the closing costs on the new loan. The payoff could be higher if you have a prepayment penalty, something like that. The type of loan can impact what your total payoff is, but it's not going to make any difference in terms of your closing costs. But Jeb, we have some alarming news that Wesley had shared with us earlier. He is homeless. He had moved from Lakewood to Las Vegas to own a home, but he says now he is homeless. I believe Wesley is yanking our chain. But Wesley, tell us the details of your homelessness and what could possibly be going on.
All right, there you go. In the meantime, Moneybags says, speaking of rates, do you think rates will move to the downside if Fed Chair Powell cuts rates? So I mentioned it a moment ago. I say no. I do not think rates move down if the Fed cuts rates at this point, because what is out there has been very transparent for the remainder of the year. What makes rate cuts happen, I guess, would be if something more happened on the rate cut front than was the market was expecting. In that sense, yes, you could see a big move. The spreads will tighten a little bit, rates will come down, but it's not going to be what you think.
Look at it this way, Jeff. I always like to say, chicken or the egg. If Powell cuts, it's because the economy is doing things that is giving him confidence that they're okay to cut, aka weakening. Inflation is moderating, employment is weakening, and the market will also see that. So we saw a few weeks ago when things were kind of trending in that direction, we saw some improvement in rates, and now we've got a couple of hot reads. They're going the other direction, and it's been that way for a couple of months now. So we're just chopping in this range. But to get a extended move one way or the other, the Fed is looking at the same things that market participants are, meaning bond buyers and sellers, and the market will move ahead of the Fed.
Good stuff. There you go. There's your answer. All right. I don't know that we got a lot of more questions here, Josh. So
I feel a lot better because Wesley came back and clarified he is not homeless. He should only be taken seriously 26.8% of the time, which means that, Wesley, we're going to have to take you seriously at least twice as often as we have to this point. So I appreciate
that's a lot.
The thorough
double.
number. It's double, at least double.
Oof. I don't know. Do we have that in us, Josh?
So, Jeb, if we don't really have questions, I have a comment. And the comment that from my friend here in Olympia, Chanel, says rates should not come down. Prices should. Mm-hmm. Both rates and home prices do not give a shit what you think. These are dictated. That's
going to be a tough conversation when you have beers, Josh.
We're going to have beers and we're going to talk it through. And I'm not talking about what you think, what anyone thinks. There are laws of economics, supply and demand. And where we're at, rates are where they are. They have not come down because we haven't seen inflation come down. We haven't seen a recession. We haven't seen the economy cool. So rates have not come down. So this job owning, and we usually say, rates also don't care what the president thinks they should be. It's the laws of economics. And the same thing with houses. Everyone looks and says, hey, home prices need to come down. Home prices don't care what you think or what you need to be able to buy. They only care about the laws of economics, primarily supply and demand. So supply and demand comes down to also, we have homeless people. So there's always people who would happily buy a home if it were $1 a month, no lack of supply of demand for homes. Right now, affordability sucks. So we have a lack of able demand, very limited demand when we have only 4 million roughly annual home sales, when the normal market is almost close to 6. So from that perspective, I just want everyone to stop thinking, I want this, I need this, I think this, and watch the economics of what's going to happen. We have a lack of supply of homes in most parts of the country. Olympia, Washington, where you're at, Chanel, there's not. It's better than Southern California in terms of more land and area to build homes, but there's not a lot of land and area to build homes. So from that perspective, just look bigger picture versus what you want or need.
All right, there you go. Let's see. Platinum Black had a question here, Josh. Actually, no, it was Rosario first. Let's go. Jesus Rosario is in Florida watching, Miami. Working with a lender who's quoting them 6.49% on an FHA loan, putting 3.5% down, asking if that's competitive. So, Josh, today, where are mortgage rates on FHA? I know we need some more information here, but in general.
It should be a little bit lower than that. So 680 plus credit score should be in the range of 6.25. Have a VA purchase that we locked earlier this week at 6.125. It was a very, very well qualified borrower and a big loan. So 6.25. Is about where I think it would be. And Jesus, the beautiful thing is we can help you in Florida, any part of Florida. So use the little crawl there at the bottom. We would be happy to look at the numbers. And any of you guys, if you're looking at numbers, you have numbers. So Barry has, hey, my sister has numbers. If you have numbers, I can tell you at least 30-40% of the time we look at them and say, hey, you're in good hands. This person's, if they're giving you good answers, if they're communicating with you, you have good rapport with them, these are perfectly reasonable numbers. But I would say 60% of the time, there's money there to be saved, and or they're not getting that communication, they're not getting that comparison.
And Wesley with the $5 super chat, saying that YouTube brought out his competitiveness, and now he's a top fan. So, hey, listen, if you guys want to beat Wesley, which I think everybody should try to do.
Yeah, everyone should try to beat Wesley.
You should give $6, and then we'll see what happens. We'll see who the top fan here is. I wonder if there's someone that's a bigger fan. Did we turn on
the scoreboard? The YouTube fan scoreboard is a new thing. Did we turn it on? Do we even have a YouTube? Did Wesley find something that we didn't even know we had turned on?
I did see something for it, but I don't know that you do anything. I think maybe it shows on their side.
Magically there.
Well, I think because we're in StreamYard, it shows this way, but I think if you're on actual YouTube, it shows in a different way. Maybe that's
Okay.
what those numbers were that we saw the other day.
Okay. Well, Wesley, I want you to give us all of your money, and you can remain top fan.
Yes,
Then you
all
may
of
then
it.
you may be homeless, whether you
Yes,
like it or
all of it.
not.
Yeah, but I think there's probably a bigger fan out there than Wesley. I mean,
No, Wesley says he's never been number one anything before. He wants to know what he does now. You get an educated
you
home
stay one.
buyer
You stay
tank
number
top,
one.
and you run around town. You stay one. You defend it at all costs.
Yeah.
You defend that honor at all costs, including
Yes.
going
If
broke.
anybody comes in, you defend that and say that you tell them to back off. That's it. We could send you a T-shirt, Wesley. How about this? Send an email to Josh or myself, and we'll send you a shirt, an Educated Homebuyer Podcast shirt.
Maybe
Look at this.
Oh, Jesus coming over the top.
Sorry, you just lost your shirt, Wesley.
Wesley, you better. That we'll see about your competitive streak here right now.
Jesus, thanks for the $10 super chat. Has a 760 credit score, and the purchase price is $575. I'm thinking your 6.49% FHA rate can be quite a bit better. Is that a condo or single family? And
with FHA, they don't have the condo
matter.
hit.
It doesn't
So
matter. That's right.
we're good.
Yeah.
So it's a standard balance condo with a 760 credit score. You're going to be able to save some money there. Is that not an atrocious rate? I hear people do reach out and I go, oh my God, there's someone trying to just take all of your money. That's not a terrible quote that you got, but definitely we can save you some money.
There you go. All right. There was another question here, Josh, before that. Platinum Black wants you to stop having fun and email some loan estimates because they're spending too much time on Redfin and need to be brought back down to earth. So
I apologize, Greg. We've been having fun on the golf course.
You just gave up their identity.
I doxed him. Right here on the internet. I apologize. I'm way out of line.
Gonna have to go a different direction now.
Yeah.
Unbelievable. But let's talk about that. So here's why I think pre-approval is important. Pre-approval is important before you start shopping on the internet, because what's going to happen is the more you shop on the internet, if you don't know or you have that line in the sand, you're going to continue to trend up in price. What can I get? What can I get? And guess what? The more you spend, the more boxes you're checking on that non-negotiable list. So if you have some certainty as to where you need to be, kind of keeps you from going up into those crazy price points and fooling yourself and getting emotionally attached. So do the right thing, get pre-approved up front, then start shopping for the home. That way you're not letting yourself down if and when you can't actually get what it is that you've been trying to find, with regards to a home. So Chanel asks, is it okay to offer $40,000 below asking price? Sure. I mean, yeah, nothing is not. I mean, everything's okay. But understand what you're talking about, right? If it's a $400,000 home and you're offering $40,000 below, that's 10%, right? That's a big number. Unless the property's significantly overpriced. Whereas if it's a $1 million home and you're doing $40,000, that's what, 3.5% or 3% or something along 4%. What did I say? If you're offering 40,000, $1 million, is that 4%?
4%.
Yeah. So a little more reasonable, right? So I think it's about context, right? Why is 40,000? What's 40,000 have to do with anything? Is it where the comps are? Is it something that you can only afford up to that price, and that's why you're throwing out that number? You need to know more there, so that you can make a reasonable offer and be able to tell the other side why you're making that offer, because that always helps in the negotiation process. Your agent should be trying to have that conversation. Let's see here. We've got Lovely Bend Home. Oh, okay. So we got a real estate agent, I think. Lovely Bend Homes in Oregon. Bend's beautiful. Love Bend.
Bend is amazing, Jeb. I am in the process of planning a Bend vacation for next summer, so I can enjoy golf and lake time there.
My wife and I would like to be included on that.
You can be included. So if there are Lovely Bend vacation rentals, Kim and Christine, that you have and you could share, let us know.
We want to stay on the Sun River. We found a place we want to stay in already. So we've been eyeing it, Josh. We've been close to pulling the trigger. When I went up there a couple years ago. Huh? Yeah,
we're already on it.
Yeah, we were looking for a while. In fact, when we went up there a couple of years ago, I did on a golf trip, man. I played some amazing golf. It was fantastic. So I'm down to do that again. Let's see. Slow Motion Fome says, not sure if you guys know this, but what would the typical homeowner's insurance rate in LA County, new construction, 4,600 square feet? I can't give you a rate. I can't really give you a price on that. It's a big house.
That size of home is at least $2 million new construction in LA County. So
sure. And then where in LA County? Are you in a high fire area? Are you like, there's a lot that goes into this.
It could be as low as $200 a month. It could be as high as $1,500 a month.
But I have a great insurance broker that I'm happy with. He's in Southern California here. If you need a referral, you can reach out via email. I'm happy to put you in touch with him. And, again, he's a broker. He can, shop rates and then tell you what's out there.
I just wanted to point out that Wesley's still in second place.
Oh, Wesley, he might even be in third. I think there's people out there that are better than Wesley. That's
I heard he was competitive. I heard he had that Mamba spirit, but apparently not.
No. He's a Clippers fan. There's no Mamba in him.
So yes.
I mean,
way better than lame-o Mamba spirit.
He's a Clippers fan. There's no Mamba in that guy. All right. Well, I didn't get back to saying lovely Ben home. She said that it was her first time watching and great to have a realtor and lender on together. So Christine, thanks for being here. Thanks for the support. Thanks for watching the channel and the kind words. We're here every Wednesday, 5 p.m. Pacific Standard Time, most of the time, sometimes a little bit early. Sometimes we come on at 4:30. But we've been doing this for 3-4 years at this point, and it's been a journey. We used to go 2 hours. Used to have hundreds of people on here at a time, 3, 4, 5. I think my most ever was over 500. But now we're lame. We're getting like 100. It's all good. It's all good.
Supply and demand.
Supply and demand. Let's see. There was another question here. Vajcheng. I can't read it from where I am, but can one negotiate on either price or options or credits after signing contract for new construction? If so, is an addendum needed? So I think yes. I mean, the answer is yes. You can negotiate things after the fact. But what I would suggest is if you're buying anything and you're asking for, credits towards closing costs, credits towards buy downs, that sort of thing, that's going to be requested in your initial offer. Things like repair credits to fix things, that sort of thing, that can be negotiated once you're already in contract. Now you're buying new construction, so you're not really going to have that repair piece of the puzzle. So I would tell you to try to do as much negotiating upfront as possible. And then you need to do it before contingencies are removed. Otherwise you're probably not going to make much progress on that. So just my 2 cents. Josh, will the new Vantage score create a bigger competition for people looking to buy a home? Are FICO scores no longer being looked at?
So no, FICO scores can absolutely still be used, and they are the only thing being used right now. FHFA just put out an FAQ today. Say that 10 times quickly. Today,
FAQ.
That I have not had the time to read and go through, but it's going to be a while. The automated underwriting systems for Fannie Mae and Freddie Mac have to be updated to be able to accept and use Vantage scores. All of the credit bureaus that lenders like myself use have to offer them. They've got to figure that piece out of it. So I would say like 90 days is the earliest that you're going to see this. It could be 6 to 12 months before you actually see them rolled out. Here's where I'd like to put it into context on this. There's about 35 million households with no credit score that could be scored under Vantage because it pulls in more data. So does that mean we have 35 million additional potential home buyers? No, but I believe they say like 25% of those, or 8 or 9 million of those households, would have scores high enough, 620 and above, to FHA conventional loans. They would be eligible for that. So again, so now we've got 6 million more buyers. Does that mean they're all in the market now today? Probably not. At any given time, maybe 10%, but that's still 400,000 to 600,000 more buyers than what we have right now. So it would be some additional competition, most likely in the entry level where we least need additional competition. It will be interesting to see how it plays out, and we're not going to know for another 6 to 12 months.
All right, Joyce says, is it normal for property taxes, homeowners insurance, and other fees to go up when a loan is transferred to another lender? Carrington. No, it's not for when it gets transferred. What happens is typically there's The increases happen when the annual tax bills come out, when the annual insurance bill is due. If it coincides with, the year, that, when you got your loan and those things come out, yes, it can happen, but it has nothing that I'm aware of to do with the transfer. It has to do with the new statements coming out, them not having enough in your impound account to cover them. And that's the reason that it goes up.
The lender is required once a year to do a reconciliation on your impound account and make sure that they don't have too much in your account, which occasionally happens, and they have to give you a refund. Or what happens more often is because taxes have gone up, insurance has gone up, there's going to be too little. And by too little, it can truly either be too little to pay the bills or not enough to keep the pad that lenders are allowed to require in there. So once a year, you're going to get an adjustment one way or the other.
Good stuff. Willing says, could you match a 10-year fixed at a 5% interest rate for a $2.8 million jumbo loan, Josh?
That's a very unique product to be at that interest rate. A 10-year fixed generally is just marginally better than a 30-year, 0.25%, 0.5%. So most lenders would be above 6%. We used to have a couple, one very specific banking relationship that we had an exclusive relationship with here in SoCal, and they had numbers that were kind of crazy like that, but not quite that good.
So our buddy Chris texted me today. Jumbo ARM pricing, so loans over $806,500. No points, need at least 20% down. He has a 7-year at 5.52. A 10-year at 5.61. If you're able to put 30% down, it drops to 5.38 and 5.46. So low fives, but not 5%. 5% would be very aggressive.
Yeah.
So, yeah. So if you're in that jumbo market looking for something like that, you can reach out. We can guide you in the right direction there. That said, we've now been on for over an hour. Josh is on vacation. We're going to let him go. We appreciate you being here. Make sure you check out the podcast this week. Talk about mortgage rates, its impact on what's happening out there. Next week, we're going to be talking about buy downs, permanent versus temporary. But until then, make sure you buy right, borrow smart, and build wealth. Until next time, adios.
Amigos.
And hit that referral link if Josh and I can help. Scrolling at the bottom. Adios again.